Hi everyone, I am Krista McNamara, Content Channel Director with ABRN Magazine. So most shop owners are great at vehicle repair and customer service, but some may struggle with the management side of running a shop. So I have here with me today Brad Mewes. He's a shop management consultant and author of the blog Supplement Financial Insight for the Automotive Industry Professional. He uses this blog to focus on business and financial issues and corporate strategy, but all geared toward the collision repair shop. So Brad, in your latest blog, you mentioned 5 areas beyond vehicle repair that shop owners need to focus on. Can you tell us about those?
Sure. So one of the things that we do really well in this industry is we fix cars and we provide good customer service. And those are really important parts of being in the collision repair business. But as the industry evolves, there's a lot of other areas that are just as important that are often overlooked. And so it reminds me back when I was in business school. And when I was in business school, we had to take classes in certain core areas that were a requirement. If you didn't pass these classes, you couldn't get your MBA. You were not allowed to move on. And so some of those areas, marketing, information technology or IT, human resources, accounting, finance, and operations. And in the collision industry, we tend to focus on operations. We're really good at doing things. And we focus less on what we consider these outside ancillary operations of perhaps finance, perhaps marketing, perhaps IT. They become second thoughts, or sometimes they're outright ignored. And if you look at the companies that are growing rapidly in the industry, they're focused on all of these things. They have senior executives who are focused just on IT, for example. They have senior executives who are just focused on marketing. They have senior executives who are focused just on finance and managing the capital risk of a company. And so the companies that are growing well understand that this business, this industry is much more holistic than just engaging in good operations, just managing your KPIs. So it's important that we look at all of those areas and we're actively managing and actively reviewing all of those areas.
Now, finance specifically, why is that so important?
So if a company wants to grow, finance is what allows a company to grow, whether it's organic or inorganic. The reality is growth creates strains on a business. It often creates cash flow strains. It could create, obviously create management strains. But finance is what allows you to build systematic, repeatable growth. So what allows you to grow and we say grow and sleep well at night because you understand what's going to happen in the future. So there's often a confusion in between finance and accounting. And so the easiest way to think about this is finance is a very forward-looking science, if you will, whereas accounting looks at what happened. Finance is designed to evaluate and manage the capital risk that a company is to face. So in other words, to grow well in a very stable and risk-averse way, or risk-managed way, I should say. And if you look at the large consolidators, they've grown because they focused on finance. They've grown because they've taken on financial expert partners, private equity groups. They've grown because they understand how to manage the capital of their business in a way that minimizes risk and maximizes growth potential.
Mm-hmm. So obviously growth is the huge benefit of a financial focus, but are there any other benefits that shops can come away with?
Well, yeah, and so I talk a lot about growth because that's been the big story in the past 12, 24 months. But at the same time, from a business standpoint, being able to put together for example, a pro forma budget and being able to operate based off of a plan is incredibly attractive, not just if you're looking to sell or buy a business, but take a strategic vendor, for example. Take your largest vendor, and if you could show that you're a financially fit company, that you have a plan, that you've executed on that plan, you're a much more attractive customer to them. And as a result, you can obtain perhaps preferential pricing. You can obtain preferential terms on your transactions with that vendor. There's a lot of benefit to doing that. Take an insurance company, for example. If you're looking to grow and acquire more insurance companies, if you could show that you systematically create plans and and execute based off of plans, you're a much more valuable service provider to a potential insurance company than otherwise. And so there's multiple stakeholders in the business. Something else they taught us in business school is that a business is more than just about the equity owners. There's stakeholders. There's outside parties that are involved that the business has to be aware of as well. And so putting together a financially fit company allows you to be more attractive to multiple stakeholders that are active in this industry.
Well, Brad, thank you so much for the information and your insight. So to learn more and to read the full article, Grow Like a Consolidator, you can visit abrn.com/moneygrow, or you can visit Brad's blog directly at sup-co.com. Thank you.